Good morning and welcome to Charting the Markets on Monday, the 5th of June. Now, at the end of last week, equity markets rallied quite strongly, and that was on the back of the US finally agreeing to raising its debt ceiling, and also as China announced that it would try to support the property market with another business plan. And as US non-farm payrolls data came in much better than expected, we had an additional 337,000 jobs created in the US economy in the last month. And at the same time, we saw unemployment, the unemployment rate, rise to 3.7%. But at the same time, we also had wage growth tapering off. So all of this meant that market participants thought that this month's Fed meeting, the Fed is unlikely to hike its rates, and that the next meeting in July might probably be when the rates will be hiked one more time. So on the back of that risk-on sentiment, we had global equity markets rallying. We also saw that earlier this morning in Asia, and as you can see here on the daily financial bet of the FTSE 100, last week we not only broke through the 200-day simple moving average, but also through the 1-week downtrend line, and have now risen and currently are retesting the high seen from last week around 7,660 on the FTSE 100 here. Now, above 7,660, there's further resistance at the mid-May low at 7,679 and at the orange line here, which is the 55-day simple moving average at 7,719. So basically, there's a lot of resistance just slightly higher than where we're trading at the moment, and that may cap the FTSE 100 later on today, because we have data coming out of the US at 3 p.m. We've got the US ISM services PMI for May, and we expect that index to rise to 52.1 from 51.9. So we'll have to see whether we will be capped with regard to the upside here short term or not. If we were to, support really can only be seen at last Friday's low, that is the low 2 weeks ago, sorry, at 7,556. But from a technical perspective, basically, as long as we stay above the low we saw last week at 7,433, further upside looks more likely in the short term than downside. And the story is quite similar with regards to the DAX 40, the German index. And as you can see here, we broke through the 1-month downtrend line and are currently flirting with last week's high at 16,080. And having a little bit of difficulty breaking through there at the moment. But we'll have to see whether that will change later on today, or whether we will stall in this area. Now, from a technical perspective, last week we held at this key support area going back to the beginning of May between 15,659 and 15,625. And this is really the support zone that needs to be watched for the bulls, because as long as we stay above there, further upside seems probable. And that could then take us back to the all-time high we made in mid-May at 16,333 on this daily financial bet. But if over the next few days risk sentiment were to change and to become more negative, and if we were to slide through 15,625 on a daily chart closing basis, then for me that would mean that we have formed a top and that we could head all the way back down again towards the March low at 14,459. But right now, the bulls seem to be in control with regards to equity markets. And the story is quite similar with regards to the S&P 500. As you can see here, we had a nice acceleration to the upside Thursday and Friday of last week on that US debt ceiling bill being signed into law by the President Biden. And basically, we're now trading at levels last seen about 9 months ago at 4,290. On the daily financial bet, and slightly above there you can see here, if I zoom out, the high going back to August of last year at 4,325. So that's the next upside target for the S&P 500, and we'll have to see whether we can break through there or whether we will struggle there and come off again. And for the bears to be back in control, what we would really like to see is not just a fall through the last reaction low, that is to say last week's low at the end of May at 4,166, but also the low here at 4,104. If we were to fall through here, it's quite likely that we would slide back down again towards the red line here, the 200-day simply moving average of 3,970. But as I've been saying, equity markets look bullish for the time being and are more likely to continue to head higher than to reverse to the downside from here onwards. Last week, the US dollar started to stall slightly on these worries that no debt ceiling agreement may be reached before the US would be heading into a possible default today on the 5th of June. But it has all been averted at the last minute, like it has every time so far in the past few years. We have to see whether the US dollar will now start to appreciate again, having slightly come off last week, or whether it is not going to happen. And if you look at the euro, which makes up 57.6% of the US dollar basket, you can see here that the inverse has happened last week on that weaker US dollar, short-term weaker US dollar, I have to say. We bounced from a 2-month low 106.36 to Friday's high at 107.79, but then we formed this dark cloud cover, and today we're heading back down again on that stronger dollar. So the dollar is appreciating, despite the fact that market players seem to think that the Fed was not going to hike its rates at its June meeting. But we'll have to see whether that current dollar appreciation can continue in the course of this week. If so, euro dollar is expected to not just retest this tentative support line going back to March of this year at around 106.44, but it's likely to also test last week's low, and that is to say the May low at 106.36. And a fall through there would then take us back down again towards the January and March lows at 105.16 to 104.84. And you also have the red line here, the 200-day simply moving average, coming into that support area. So this is the main support area for euro dollar, because a fall through there could really change the medium-term trend. Right now, it's a medium-term sideways trend, and within that we have a short-term downtrend since the May highs, which were made at 110.95 on this daily financial bet. And basically, as long as we stay below last week's high at 107.79 on a daily chart closing basis, further downside looks to be more probable than any upside. And with regards to euro sterling, the picture's slightly different here, because what we can see here is basically that the euro, which last week, for much of last week, declined very sharply on softer eurozone headline and core inflation data versus the British pound, formed a low at 85.68, just made marginally above the December low at 85.48, and now we're currently bouncing back off that support area and heading back up towards the 24th of May low at 86.49, and also the 11th of May low at 84.66. And that's the resistance area within which we can also see this 1-month downtrend line, and that may cap the upside over the next few days. For the bulls to be back in control on this chart, what we would really have to see is a rise above the last reaction high, that is to say the high on the 23rd of May at 87.19, and only if we were to close above there could we say that we are forming a reversal pattern to the upside. But right now, on that anticipated rate differential between the European Central Bank, not expected to hike its rates necessarily at the next meeting, but the Bank of England definitely expected to continue to do so, we could see further weakness in this euro-sterling currency pair. Moving on to the British pound against the US dollar, this chart is kind of interesting because last week we failed at the mid-April high at 125.46. We went to 125.44 on this daily financial bet as the US dollar was depreciating slightly, and on that higher expectation that the Bank of England will continue to have to hike its rates because of the stubbornly high inflation rate in the United Kingdom. We saw this 5-day consecutive rise in the price of cable take us to 125.44 on Friday, but since then the stronger US dollar has taken the upper hand again, with the currency pair slipping back down towards its tentative support line going back to March of this year at 123.62. So that would be the next downside target for cable, and if we were to fall through there, then we have 123.09, which is to say the May low, which is the key support area, because if we were to fall through there, we would most likely not just fall through the mid-February high 122.70 and the late January low at 122.63, but could also head back down again towards the psychological 120 area. But right now, we'll have to see whether we can hold at that support line here, as I said, around 123.62 or 60 on this daily financial bet. Commodity markets have been relatively volatile as of late as well because of this rising and then a little bit depreciating US dollar at the end of last week before it started to ramp up again. And we also had some news out of OPEC Plus over the weekend, where basically OPEC Plus is on track to cut output once again. And if we look at the price of Brent crude oil, we can see that basically here we've had a gap higher overnight because Saudi Arabia pledged to reduce output by another 1 million barrels per day from July onwards. And that would bring the country's production levels to around 9 million barrels per day next month. And that has led to the price of crude oil bouncing up. As you can see here, we had a gap higher taking us back towards $77.51, which we're currently being trading above, and towards last week's high at $78.52. So that's the next upside target for Brent crude oil. And we can see that basically we're also approaching the orange line here at $78.47, which is the 55-day simply moving average. So we've been trading nearly for months now in a sideways trading range with regards to Brent crude oil, and now we are retesting the upper range of that trading range. And if we were to break out of it, we could then re-enter the previous trading range, which was made between the January and February lows around $77.65 and $79.04, and the upper range between the January and April highs between $87 and $89. So we'll have to see whether we can break above $78.52 and close there on a daily chart closing basis, in which case the 200-day simply moving average at $84.60 would be back in focus. So that is really interesting from a technical perspective. Can we break through that level? Can we break through and above $78.52? Or will we once again fail there and then come back down again towards this recent 1 month sideways trading range between basically $71 and $78? So the jury is still out on that one. Moving on to gold, the gold price with the appreciating US dollar is once again slipping. Last week it rallied to $1,983 per troy ounce, but then it failed just below the orange line here, the 55-day simply moving average at $1,989. And right now we're retesting the November to June uptrend line here at $1,940. And basically, if we were to fall through there, and also last week's low at $1,933, then further downside looks likely, because in that case, we could be forming a head and shoulders top formation here with the neckline coming in around $1,930. And that would mean that we would most likely be heading down again towards the red line, the 200-day simply moving average, $1,837. But let's not jump the gun. We would have to fall and close below $1,933 for this to happen. Right now, this is not the case. It hasn't happened yet. Yes, short term, we do look bearish. And yes, the odds look more favorable to the downside than the upside. But we have to wait for that to close below 1,933 for the pattern to actually be triggered. Now, for the bulls to be back in control with regards to gold, we would have to rise above $1,983 per troy ounce and close above there. But even then, we have a pretty good resistance band here between $2,000 and $2,009 on the price of gold. Last but not least, I'd like to mention copper. And you can see here the price of copper which had been coming off on recession worries with regards to the global economy over the last few months since the mid-April highs of $9,182 per ton. Well, here basically last week we rallied to the red line, the 200-day simple moving average, which at $8,381 basically capped the upside. So right now we're trading below there as resistance continues to cap. But it is becoming more interesting, because if we were to manage to rise above $8,381, that is to say Friday's high this week, and close above there, then the way would be open for further upside to take us back not just to the orange line at $8,594, the 55-day simply moving average, but probably also all the way back up again towards the $9,000 mark. Now, if we were to once again be capped by the 200-day moving average, however, we could see a slide towards the previous downtrend line, which has been breached because of inverse polarity, which now should act as support around the $8,064 mark. And we also have support going back to mid-May, the lows here at $8,089. So that's another possible scenario. But short term, you can see here the price of copper does seem to want to creep back up again. Thank you very much for watching Charting the Markets with me, Axel Rudolph. Please feel free to follow me on Twitter. My Twitter handle is @AxelR_IG.